Silver trades at $69.41 on the COMEX spot right now, but physical bars vanish from vaults at premiums hitting 30%. That's not market efficiency. That's rupture. Banks, short 450 million ounces in paper contracts, just watched their kill switch. A $67 threshold meant to force liquidations. Backfire as squeezes cascade through futures. Overnight rule tweaks by exchanges, capping position limits without warning, expose the naked shorts. Liquidity evaporates while demand surges 120% year to date. The system's not bending, it's breaking in real time. This anomaly isn't isolated. It signals the unraveling of a control mechanism that's held for decades. Look at the data. Silver's up 120% in 2025, outpacing gold's 64% climb. Yet fabrication demand, industrial use in solar, electronics, batteries, only accounts for half that move. The rest, pure investment flight, triggered by the same forces dumping dollar assets en masse. China slashed its U.S. Treasury holdings by $520 billion since 2013, accelerating to $280 billion in the last 3 years alone. Russia liquidated 98% of its $96 billion position from 2018, leaving under $2 billion. That's over $600 billion exiting bonds, not into stocks or crypto, but into hard assets that no central bank can print. Here's where the logic fractures. In a stable system, foreign powers diversify quietly. But this is synchronized exit. China and Russia coordinating dumps timed to Fed meetings and debt ceiling votes. They didn't just sell, they repositioned strategically. While treasuries flooded the market, central banks globally hoarded over 1,000 tons of gold in 2024, the highest since the 1950s. But silver? That's the underreported twin. As the industrial metal on the U.S. critical minerals list, silver's supply chain tightens under tariffs and export curbs. China's domestic production, 370 tons annually, stays locked in, fueling their tech dominance, while imports through Shanghai spike. Estimates peg China's unreported silver holdings at double official figures, mirroring their gold playbook. The kill switch mechanics expose the vulnerability. Bullion banks, JP Morgan, HSBC, the usual suspects, have suppressed silver via concentrated short positions for years. Fined billions in the past, but never deterred. In 2025, as prices pierced $48 in November, then $65 in December, the $67 level activated automated covers. But the rule change, exchanges quietly imposing stricter collateral requirements overnight, turned suppression into self-destruction. Shorts can't roll indefinitely. Physical delivery demands now bite. Result, a $2 surge in one session, halts on trading, and banks scrambling to buy back what they never held. This isn't volatility, it's the paper market divorcing reality. Zoom back to the debt spiral fueling this. U.S. national debt at $36 trillion, adding $1 trillion every 100 days. Interest payments top $1 trillion annually, more than Medicare, veterans, education combined. The Fed's trapped. Raise rates, add $360 billion per point to the bill. Cut them, reignite inflation above 3%. China and Russia solved this equation years ago, concluding the dollar's integrity cracks under the weight. Their exit validates alternatives. Shanghai Gold Exchange morphed into a silver hub too, trading volumes surpassing London. CIAPS processes $17 trillion in yuan settlements, up 50%, bypassing SWIFT. BRICS expansion to 10 nations, 42% of global oil, declares local currency trades, with silver as collateral in energy deals. If you tracked silver futures or held physical through this surge, how does this kill switch failure look from your vantage? Share your observations in the comments. Did you see the premium spikes firsthand, or catch exchanges' quiet memos? Compare this to historical fractures. The British pound's collapse from 1945 dominance to 1976 IMF bailout followed identical phases. Creditor exits like France demanding gold, emerging alternatives in dollars and marks, then exponential rush. Pound's reserve share dropped from 65% to under 20%. Dollars at 58% now, down from 72% in 2002, accelerating post-2020. Silver amplifies this. Its dual role as money and industrial input makes it the canary. In 1980, silver rocketed from $5 to $50 on short squeezes. 2011 saw $50 peaks on debt fears. Now, with production flat at 3,000 tons yearly against surging demand, the math demands explosion. Central banks eyeing 40% hard asset backing need 18,000 more tons, 6 years output. But silver's above ground stock? Tighter, with industrial offtake consuming 60% mined supply. The system's losing grip here. Foreign holdings of U.S. debt fell from 34% to 29.5%, shedding $2 trillion. Domestic buyers, pensions, insurers absorbed the gap, but the Fed's the backstop, printing to buy its own bonds. That's not sustainability. That's circular illusion. China didn't just hoard. They built infrastructure. Petroleum for oil, now extending to silver-backed contracts, with Saudi Arabia shifting 20% of exports to yuan. When oil trades without dollars, silver's role in green energy, solar panels devouring 150 million ounces yearly, pulls it into the vortex. This non-linear path reveals the interconnections. Geopolitics feeds logistics. Sanctions on Russia rerouted silver flows, spiking premiums in Europe. Military spheres intersect. Silver in electronics for drones, missiles, heightened strategic stockpiling. Ethiopia and Iran joining BRICS locks in African silver mines under non-dollar pacts. The silence from regulators? Telling. No SEC probes into the overnight rule shifts. Media buries the $67 trigger under holiday headlines. That's not oversight. That's complicity in a failing regime. For those in mining or trading, if you've noted discrepancies between COMEX deliveries and actual vault stocks this December, detail it in comments. What patterns emerge when paper promises meet physical reality? Push deeper. The kill switch wasn't meant for this. Designed post-2008 to prevent runs, it now forces banks into panic buys, draining liquidity from critical sectors. Healthcare tech relies on silver. Transportation electrification demands it. Disruptions here cascade. Supply chains fracture as refiners hold back. Premiums hit 30% in U.S. dealers. This mirrors the 2022 nickel squeeze on LME, where rules bent to save big players, but silver's decentralized. Shanghai sets parallel prices, undercutting COMEX authority. Historical mirrors sharpen the view. Bretton Woods' gold peg broke in 1971, unleashing inflation. Gold jumped 2,400% to $850 by 1980. Silver tagged along, multiplying value as currency debased. Today's projections. Analysts at $100 per ounce by mid-2026 understate if crisis hits. Assumed dollar loses 30% purchasing power in 5 years. Conservative, given printing trajectories. Silver doesn't just hedge, it leverages the downside. Banks' failed suppression, exposed by 2025 fines and ongoing probes, accelerates the shift. JP Morgan's nightmare, their silver vault, once a dominance tool, now a liability as deliveries spike. The process builds. Symptoms first. Price rips, halts, then causes surface. Debt paralysis forces Fed inaction. Inflation sticks. Geopolitically, BRICS' October 2024 declaration on local settlements operationalizes the bypass. Russia's SPFS connects 159 banks, volume up 60%. This parallel system processes trillions, siphoning dollar demand. Silver's inclusion as critical mineral amplifies. U.S. tariffs backfired, pulling stocks stateside, tightening global spot. London's liquidity crunch? Direct result. Premiums diverging from paper by 20%. If you're analyzing central bank reports or TIC data, how do you interpret the acceleration in Treasury dumps alongside silver's surge? Coincidence or linked signal? Weigh in below with your take. Unpack the behavioral signals. Large players pivot to physical. Institutional inflows to silver ETFs outpace gold in 2025. Returns moderating, but volumes record. Pension funds, once dollar bond heavy, allocate 10 to 20% to precious metals. The anomaly? Media tiptoes around it, focusing on stock rallies, while silver sets daily highs. That's the silence as signal. Control narratives fray when facts overpower. Logistics layer. Mine production stagnant. Recycling covers 20% gap, but industrial pull. Solar up 50% globally, eats reserves. China's law bans silver exports, building internal buffers over 3,000 tons estimated. Russia's reserves, fifth in gold, likely mirror in silver for energy tech. The fracture point. When BRICS flips to primary, silver-backed trades dominate commodities. Oil and yuan, settled with silver clauses for green premiums. This isn't growth, it's divergence. Paper price caps failed because physical demand, 1 billion ounces yearly, overruns manipulation. Banks' kill switch, meant to deflate bubbles, inflated the squeeze. Overnight rules, position caps from 100,000 to 50,000 contracts, intended stability, but triggered covers. $2 billion daily losses. Systems instability manifests. Volatility not from news, but structural rot. For viewers in finance or precious metals, if you've spotted similar rule tweaks in other commodities this year, connect the dots in comments. Does this pattern hold across markets? intertwined with military angles. Silver's conductivity makes it irreplaceable in hypersonics, radars. U.S. stockpiles dwindle under export curbs. China's dominance in refining, 60% global, weaponizes supply. Geopolitical flashpoints. Taiwan tensions, Ukraine stalemates, spike precautionary hoarding. History echoes. Post. World War II. Silver shortages delayed tech rollouts. Now, amplified by debt-financed arms races. The narrative thickens. Consequences precede full causes. Liquidity problems mount. U.S. refinances $2 trillion debt yearly. Foreign buyers vanish, forcing domestic overload. Pensions buy bonds at yields spiking to 4.5%. But silver's 120% return lures capital away. Alternatives validate. Petroleum at 20% of China's oil, set to expand with Saudi BRICS entry. When 42% of oil producers shift, dollar craters. CBO projections bury the trap. Debt to $54 trillion by 2034. Interest $1.7 trillion at 3.6% rates. But at current 4.5%? $2.43 trillion, eclipsing Social Security. Binary endgame. Default via high rates or inflate away. China and Russia exited pre-trap, their $600 billion fueling hard asset stacks. If you've modeled debt scenarios or tracked reserve shifts, share your projections in comments. Where do you see the tipping point for silver in this mix? Phase analysis. Like pounds decline, dollars in phase 2. Alternatives operational. SIPs, SPFS Live, BRICS Framework. Eyes Gold, Silver Hybrid Settlements by 2026. Trigger windows, January 2026. Debt ceiling brinkmanship. Potential Chinese silver sales spikes. March. BRICS announcements could rocket silver $200 to $300. Q2. Fed trap. Sticky inflation forces hands. Dollar index below 95 signals flight. Late 2026. Petrosilver expansion. If Saudis offer yuan/silver for oil, game over. By 2028 to 2030. Reserves below 50% reverse network effects. IMF SDR reforms loom. Weighting yuan. Introducing precious metals components. Silver's math seals it. 212,000 tons above ground, but industrial eat 800 million ounces yearly. Central shifts to 40% backing, demand 18,000 tons. Supply overwhelmed. Price to $100 probable. Crisis mode, $150 to $200. Not hyperbolic. 1980s, 2,400% precedent. Adjust to $5,000 equivalent, but conservative at $4,000 to $5,000. The process peaks. Banks failed kill switch on silver, unmasked the broader loss. No hysteria needed. The data indicts. Debt unsustainable, exits coordinated, alternatives built. Silence from Washington. The loudest alarm. This phase locks in. Control slips irretrievably. For those observing global flows or holding positions, how has this silver fracture altered your view of dollar stability? Detail your insights in comments to build the picture. The system's fracture endures, unyielding to patches. Vaults report registered silver at 150 million ounces, down 47 million in the first week of December alone. While COMEX futures open interest hits 180,000 contracts, equivalent to 900 million ounces. Spot holds at $69.63 per ounce today. But physical dealers quote 25 to 30% premiums on bars vanishing from shelves. Banks' net shorts, estimated at 450 million ounces naked across COMEX positions. Face margin hikes to $22,000 per contract after piercing the $67,000 kill switch threshold last Friday. Trading halts fired repeatedly. Exchanges slapped overnight position caps at 50,000 contracts from 100,000, forcing automated covers that rip prices $2 an hour. This isn't fluctuation. This is the paper facade cracking against physical reality right now, as deliveries spike and liquidity seizes. The rupture spreads. Shanghai Gold Exchange silver premiums explode to $2.50 over COMEX, with SHFE stocks plunging 45% from 2024 peaks. 112,000 ounces withdrawn in a single day. China's export ban on silver kicks in January 1st, locking 370 tons annual production domestic, prioritizing solar panels, devouring 200 million ounces yearly. India sweeps 21 to 31 million ounces monthly. BRICS nations reroute flows, leaving London vaults at 711 million ounces, lowest ever, 400 million below 2021 peaks. COMEX eligible to registered ratio inverts to backwardation persistence, not a blip, but structural signal of depletion. Bullion banks like JP Morgan flip net long on paper after years of suppression, per CFTC whispers. but the math indicts. Their shorts exceed global float by multiples. Where the control unravels first, delivery mechanics. COMEX Rule 7, born from 1980. Hunt squeeze allows emergency position limits and cash settlements. Invoked then via retrospective liquidation bans. Now, with December 29th contracts looming, 2,550 gold and 0 silver notices yesterday mask the strain. 616 million ounces withdrawn July alone. JP Morgan issuing 645,000. Banks scramble airlifts from London, but LBMA float exhausts. EFP premiums spike 0.80 in 48 hours. This echoes 2020, when shorts honored last minute via cash. But 2025's deficit, fifth straight, at 117 million ounces per Silver Institute, amplifies. Industrial fabrication hits 665 million ounces, 60% of mine output flat at 1.05 billion. Debt's shadow accelerates it. U.S. refinances $2 trillion yearly as foreign treasury buyers, down 4.5 points to 29.5% share, $2 trillion shed. Pivot to atoms. China's $520 billion treasury dump since 2013. Russia's 98% liquidation funnels $600 billion into 1,000 plus tons gold. Unreported silver mirroring at 3,000 tons. BRICS at 10 members controls 42% oil. CIP's volume $17 trillion, up 50%. Petroleum at 20% China's imports. Silver collateralizes green deals. Dollar reserves slip to 58%, accelerating post-2020. Below 50% by 2028 to 2030 reverses network effects, per IMF COFER. If you're sourcing physical silver or tracking dealer premiums amid this COMEX Shanghai divergence, what gaps do you see between quoted spot and actual availability? Drop your ground-level read in the comments. History's fracture lines align precisely. Pound sterling's 1945 to 1976 implosion. Phase 1 creditor exits. De Gaulle's gold demands. Phase 2 alternatives. Mark, dollar. Phase 3 stampede. Reserves from 65 to 20% in decades. Acute crisis in 18 months. Dollar mirrors. 72 to 58% since 2002. Velocity doubling post-2020. Silver's 1980 Hunt parity. $50 ounce versus oil barrel. Returns as vaults drain. 2011 $50 peak on debt fears. But 2025 diverges. No easy gold left, production stagnant decade. Silver's industrial inelasticity. Topcon panels up 20 to 40% usage. Consumes reserves while sovereigns stockpile. The instability locus. Fed's trap. Debt at $36 trillion. $1 trillion interest eclipsing Medicare. Every rate point adds $360 billion. CBO. $54 trillion by 2034 at 3.6%. Yields $1.7 trillion payments. But 4.5% reality? $2.43 trillion. Devouring budgets. Binary. High rates bankrupt. Low ignite inflation above 3% sticky. China, Russia exited pre-spiral. BRICS. Kazan Declaration operationalizes local settlements. SPFS up 60% volume. Banks' playbook fails here. Post-2008 kill switches. Margin nukes. Position caps. Worked on speculators. 2025 buyers pay cash. Tesla, India government. Solar fabs. COMEX margin, 10% hike. December 12th triggered Friday's red, but physical depletion drives. Vaults from 200 to 60 million ounces in 2 years. Rule changes. Spot limits at 25% deliverable supply. Backfire as arbitrage gaps widen. Shanghai repricing independently. For industrial users or miners, if China's export curbs hit your supply chain this month, how's the premium creep manifesting? Share specifics in comments to map the global strain. Non-linearity intensifies. Consequences lead. Vault drains precede price. Geopolitics. U.S. critical minerals list. Mexico 30% tariffs. Pulls flows stateside. Tightening London to 150 million registered. Military. Silver's irreplaceable in hypersonics. Radars. U.S. stockpiles dwindle. China refines 60% global. Ukraine. Taiwan flashpoints hoard. Ethiopia. Iran. BRICS entry locks African mines non-dollar. Media regulatory hush screams louder. No CFTC probes on $67 trigger despite 10-hour halts, November 28th. Headlines bury under holiday, Santa rally myths. Silence signals regime preservation. Position tables updated February 2026, but emergency overrides loom. Chatter erupts. COMEX rule tripped. Banks cover leveraged shorts. Shanghai $68.57 versus COMEX $66, physical East. Behavioral pivot. Institutions allocate 10 to 20% metals. ETFs inflow outpace gold despite moderating returns. Recycling plugs 20% gap, but solar 50% global growth eats it. Petrosilver brews. Saudi's yuan shift signals clauses for green premiums. This isn't ascent, it's detachment. Paper caps shatter on 1 billion ounce demand versus 800 million supply. Banks' $2 billion daily losses on covers expose rot. Volatility stems not events, but exhaustion. Manipulation's entropy. If you've parsed COT reports or bank filings, where do shorts unwind trajectories clash with vault data? Your discrepancies in comments sharpen the fracture view. Intersections compound. Logistics reroutes. Post-sanctions. Spike Europe premiums 20% divergence. Healthcare. EVs demand conductivity. Disruptions cascade as refiners withhold. U.S. dealers 30% over spot. 2022 LME nickel precedent. Rules bent for shorts. But silver decentralizes. SGE volumes eclipse London, undercutting COMEX. Bretton Woods, 1971 peg. Snap unleashed 2,400% gold to $850 by 1980. Silver multiplied. Analysts, $100. Mid-2026 underplays crisis. $30% debased conservative. Silver leverages asymmetry. Fines. JP Morgan billions past. Irrelevant. Vaults liability now. Process clarifies. Liquidity chokes precede. Pensions overload bonds at 4.5 yields, but silver's 130% YTD lures. Petroleum expands Saudi BRICS. 42% oil shift craters, dollar demand creators. If modeling reserves or TIC flows, your timeline on dollar tipping amid silver's industrial pull. What projections align? Post in comments. Phases lock, pound. Phase 2, operational alternatives. CIPS/SPFS live. BRICS hybrid settlements 2026. Triggers. January debt ceiling. Chinese sales. March BRICS framework. Rockets 200 to 300. Q2 Fed inflation bind. DXY below 95 flight signal. Late Petrosilver Saudi expansion ends petrodollar. 2028 to 2030 50% reserve breach. SDR reforms yuan per gold. Weighted. Silver math irrevocable. 212,000 tons above ground. Centrals hold 17%. 40% backing needs 18,000 tons more. 6 years production overwhelmed. $100 baseline. Panic $150 to $200. Probable. 1980. Adjusted conservative $4,000 to $5,000. Fracture solidifies. Kill switch boomerang. Unmasked debt unsustainability. Coordinated exits. Parallel systems trillion strong. Washington's void. Terminal confirmation. Phase in trenches. Reversibility vanishes. Observing flows or positioned. This silver schism's impact on your dollar calculus. What shifts? Detail and comments to collective trace the endgame? No reset rhetoric alters trajectory. Scarcity enforces repricing. Paper's illusion persists until industrial halt or sovereign claim snaps it. The mechanism endures. Not victory. Endurance through depletion's grind. Spot holds at $6.63 today. December 23rd. Yet physical 100-ounce bars quote $4 to $6 over in major dealers, with smaller lots pushing 25 to 30% premiums as inventories evaporate. COMEX registered stocks dip below 100 million ounces after early December's 47 million ounce drain. Over 60% of deliverable supply claimed in days, while Shanghai exchange warehouses sit at multi-year lows under 900 tons. CME's mid-month margin hikes to $22,000 per contract, and volatility scans triggered repeated halts. But the covers accelerate anyway. Banks' concentrated shorts, built over years of suppression, now hemorrhage as physical offtake. Solar alone forecast at 200 million ounces, overruns mine output stagnant near 1 billion ounces annually. This isn't rebalancing. This is the paper mechanism seizing against irreducible demand. The fracture deepens into logistics and sovereignty. China's January export lock on domestic production prioritizes internal buffers for photovoltaics and EVs, rerouting global flows while India absorbs 30 million ounces monthly. London vaults, depleted 40% since 2021 peaks, force EFP premiums to records as arbitrage windows slam shut. BRICS frameworks embed silver clauses in energy settlements, paralleling petroleum's 20% share. Dollar's reserve erosion, down to 58%, mirrors this. Coordinated exits from Treasury's funnel capital into atoms no printer can replicate. If you've navigated dealer queues or monitored vault reports through this December run, What discrepancies stand out between paper settlement and physical receipt? Share your frontline signals in comments to trace the detachment. History's precedents crystallize the endpoint. 1980s. Hunt-driven parity with oil saw $50 spikes on similar shortages. 2011's debt crisis peaked near there. But 2025's structural deficit, fifth consecutive year, cumulative hundreds of millions ounces, amplifies under green mandates and de-dollarization. Industrial consumption hit 665 million ounces, inelastic against price, while recycling and thrift cover mere fractions. The kill switch, margin escalations, position caps, fails because buyers aren't leveraged specs. They're sovereigns, fabs, grid securing conductivity, no substitute matches. Geopolitical layers compound the bind. U.S. critical mineral tariffs backfired, pulling metal stateside pre-deadline, tightening east-west spreads. Military stockpiles strain. Silver and guidance systems, radars, as flashpoints demand precautionary hoards. Regulators quiet on CME adjustments, signals preservation over transparency, echoing past interventions that delayed but never prevented repricing. The process entrenches. Vaults empty first, premiums diverge next, confidence erodes last. Debt's $36 trillion weight, interest eclipsing budgets, forces the Fed's paralysis, mirrored in silver's vault paralysis. Alternatives operationalize daily. See EPS trillions, SPFS growth, BRICS oil shares. When physical claims exceed illusions, the system doesn't negotiate, it recalibrates. For those parsing exchange data or sourcing metal amid premium spikes, how do you weigh 2026's projected deficits against current squeeze intensity? Your calculations and comments complete the map. No reversal patches this phase. Scarcity dictates terms. Endurance through depletion defines the transition. The fracture holds, widening inexorably.